In a venture capital term sheet, the key and most important issue is obviously valuation. And companies have a lot of different ways of looking at this. You oftentimes have founders who will do a discounted cash flow analysis that shows that their company is worth $50 million at the early stages, which very well may be true, although it's completely irrelevant for any early stage company. As irrelevant is trying to value a pure startup based on an earnings multiple or a multiple of revenue, where 5 times 0 revenue is 0 and so forth. And so really the way the venture capital investors look at it, it's much more about percentages. And you generally will give up the same kind of percentage, probably anywhere from sort of 25 to 40%, maybe 30 to 40%, regardless of the amount of financing that's raised. And so the amount raised really is what ends up driving the financing. A lot of venture capital investors want to have at least 20% ownership per investor. So if there's 2, that would be 40%. If there's other convertible notes or other investors involved, then that would obviously get tacked on top of that minimum 20% for the lead venture investor. And so a lot of times it's sort of, if you raise $5 million, the valuation is going to be much higher than if you raise $2 million, and that's just the way that those financings work. They're based on percentages. And the other sort of a little bit of a backdoor issue to consider is just the size of this reserve stock option pool, where it's worth sort of having an advisor or having someone who can help, really is experienced with cap tables that can run these numbers, because a 20% available stock option pool has a dramatic difference on what the real valuation is versus a 10% reserved option pool in the way the math works. So really, when negotiating valuation in a venture capital deal, it's important to note that it's really based on percentages and not any other sort of extrinsic method of valuation.